getting started, let me just give you all a brief understanding of what we are going to look at in the next 1 to 1.5 hours. So as I mentioned, initially we'll be looking at taking a look at the overview of the Colombo Stock Exchange, and in that we'll be talking about the concepts of risk and return, and then we'll be looking at benefits of investing as well. And then moving on, we'll be looking at the practical aspect of, in a sense, like how one could purchase shares. And under that, we'll be looking at a few topics as well, like primary market, secondary market, and then the types of securities, broker firms, likewise. And then towards the latter part, we'll be talking about the CSE performance indices as well. And then finally, we'll be concluding with the account opening process. So that's what we are going to look at for today during the next 1 to 1.5 hours of our time. All right, Colombo Stock Exchange, the organization. Let's look at what this organization is. Well, when we talk about the Colombo Stock Exchange, like practical terms, we do use many terms. Like sometimes we call it the Colombo Stock Exchange, and sometimes we refer to it as the stock market, and more commonly we call it the share market as well. So, like if you take the term the Colombo Stock Exchange, is actually the organization which we are talking of. And then actually the Colombo Stock Exchange is the organization which is authorized to conduct secondary market activities. We call it trading of shares, stocks in Sri Lanka. So that's the registered organization. So if you take the wording stock market, is actually the real marketplace where different securities are being traded. So when you say stock market, or the more commonly used term share market, it's not only shares that's being traded in the stock market. So there are like different instruments. Collectively, we call them securities. But for now, let's say it's shares. As we move along, we'll discuss about the different instruments, and collectively we call them securities. So stock market is actually the real market where different securities are being traded. So unlike any other market, even the stock market operates based on the concepts of demand and supply only. So if you take like just a normal market, let's say like even a vegetable or a fish market that we come across on a daily basis, even these markets operate based on demand and supply only. But the only question is, like if you take an ordinary market like a vegetable or a fish market, which I talked of, there the demand and supply is clearly visible to anyone. But coming back to the stock exchange or the stock market, when it comes to the stock market, the demand and supply may not be clearly visible like in an ordinary market. So we'll discuss that as well as we move on. So for now, even the stock market, no magic is involved. Even the stock market operates based on the concepts of demand and supply only. And then the Colombo Stock Exchange, the organization was established in the year 1985. And then, unlike any other company, it's being registered as a company limited by guarantee. And then Colombo Stock Exchange is a private organization, but then again, it's not just another private organization. Well, actually, the Colombo Stock Exchange is being overlooked and closely monitored by the Securities and Exchange Commission, which you all know is a government body, a government authority. So with that understanding about the Colombo Stock Exchange, the stock market or the share market, we'll take a look at what a share is. If you take a share represents capital of an organization or a company. So if you take the capital of a company, if you take the entire capital of a company and divide it into equal portions, equal parts, and take one portion out, one such portion would represent a share. So essentially, a share is represents ownership of a company, and of course, it has a value. So the fact that you buy a share means that you are entitled to a partial ownership of a company which you are buying shares. That's about a share. And then talking about shares and then talking about stock market, it is important that we talk about, or rather that we identify the difference between a saving and an investment. So if you take savings, yeah, it's quite obvious. I believe every one of us as of now, we do maintain some kind of a savings. I mean, like most of us do have savings accounts as well. So in a saving, what happens is, like, let's say you have some additional money, and what you do is like you open up a savings account and then park your money there. You put your money into that savings account. So what happens when you put that money, you would be able to gain an interest amount added to that capital portion which you put up in your savings account. So when you open up a savings account, you don't have to worry about it. Your interest would get accumulated over time. So that's about savings. But then again, if you take an investment, talking about an investment, let's say you decided to start your own business. You starting on business is also an investment. So let's say instead of opening up a savings account, what you do, you decide to start your own business with the same money. So once you have started your own business, you can't just sit back and enjoy. Just like you put your money in the savings account, you can't just sit back and enjoy. So like if you started your own business, maybe like even on a daily basis, you check what your income is for the day, what are the expenses, and what the profit is for that day as well. So maybe on a daily basis, you are going to calculate and you are going to check how your business or the investment is doing or performing. So similarly, when you are putting your money in the stock market, it is also an investment. So you are doing an investment. Just like you started your own business, when you put up your money in the stock market, similarly, you can't just sit back and enjoy. You would have to look into, and find out what's happening with your investment, or rather you have to check what's happening with the share prices, whether the price of the shares you have bought it has gone up or gone down. Likewise, you would have to check the overall performance of the market as well. So one should understand before investing in the stock market that stock market investment is not another form of saving. It is an investment just like you starting your own business. So with that understanding, let's look at the concept of risk and return. So when talking about the stock market or investing in shares, we often hear this term that there is a risk involved when you are going to invest your money in the stock market. So let's look at the other alternative investment options available in the market. Let's do a comparison of the investment opportunities that are available in the market. So starting from treasury bills and bonds, I have taken fixed deposits, corporate debentures, unit trust, and then shares as well into the comparison. So if you look at this graph, it's clear that the risk involved is a bit high. The risk involved in investing in the stock market is a bit high when compared to the other investment opportunities that are available for an individual in the market. But at the same time, if you take a look at the graph once again, comparative to the risk that you are going to undertake, the return which you are going to get is also high compared to the other investment opportunities available in the market. So we often hear that quoting like higher the risk, higher the return. Similarly, you undertake a risk, yes, but then again, for the risk that you are going to undertake, the return which you are going to get is also comparatively comparatively higher to the other investment opportunities available. So talking about risk. So what would be the risk involved when you are going to invest your money in the stock market? So as per my knowledge, in my view, the main risk that would be involved when you're going to invest in shares is the price of your shares which you have invested in going down. In a sense, like there is always the chance for a share price to appreciate, go up as well as go down as well. So let's say, for example, you buy a share at 10 rupees, and after some time, when you are checking, you find that the shares you bought at 10 rupees is now trading at, let's say, for a price of 8 rupees a share. So, which means you have incurred a loss. Actually, talking about the loss you have incurred, it is not being realized yet. In a sense, like you buy the shares at 10, when you are checking, the share price is shown as 8 rupees. So if you calculate on theoretical terms, yeah, you have made a loss of 2 rupees. There is a loss of 2 rupees, but that is not realized yet. So if you decide to sell the share at 8 rupees only, that loss would be realized. So unless otherwise you decide to sell your shares, there is no actual loss that you have incurred. On theoretical terms, if you do the calculation, yes, there is a loss of 2 rupees. But then again, instant, what you could do is like, if you have the holding power, maybe you decide, uh, as an example, maybe you decide to hold on for the same share for like maybe like another 1 month's time. And then after 1 month's time, when you're checking, you see that the price of that same share has gone up to like 14 rupees a share. So now, if you are comfortable with that, if you are happy with that profit of 4 rupees, you can decide to sell the shares and then realize that profit of 4 rupees per share. So that's the main risk which is in all the price of shares dropping down. But then again, as I explained, that risk can be managed. So if you take the stock market, yes, there is a risk involved, but as I explained, there are ways and means of managing or mitigating that risk which is involved when you are investing in the stock market. We'll discuss more about it as we move along as well. So for now, yes, there is a risk involved, but then again, there are ways and means of mitigating and managing the risk as well. So higher the risk, higher the returns. Now let us take a look at the returns. So the benefits one could enjoy by investing in the stock market. So these benefits I have divided into two as direct and indirect benefits. Let's take a look at the direct benefits first. Let's talk about capital gains. Capital gains. This is the deciding to invest in the stock market. A capital gain is like the difference which we talked of earlier as well. Let's say you buy a share at 10 rupees and you say after some time you sell it at 15 rupees. So that 5 rupee profit you make is known as a capital gain. Very simple. You buy at 10, you sell at 15. That difference you gain is called a capital gain. The most important thing about this capital gain is that you would be able to enjoy that gain as it is without any tax being deducted of that profit. You all know when you are making investments, like when you are to obtain the profit, like when you are to get that profit credited to your account, there would be like several deductions coming in, taxes, NBT, this and that. Your money would be in a sense like on paper you might see a profit of 5, but when it's coming to your account, you may not get the entire 5 rupees as a profit. But here, when you're investing in the stock market, that capital gain you make, you will be able to enjoy it as it is without any deductions being made. And then we'll take a look at dividends. A dividend is actually a portion of profits earned by the company being divided among the investors or the owners of the company. So what happens is like let's say companies, when they earn profits, they may decide to share a portion of their profit for the period with the investors. But it's not an entitlement in a sense, like it's the dividend entitlement is not going to be a fixed one. It could differ from company to company. In a sense, like there could be companies giving out dividends, there would be a dividend for the shareholders. And on the other hand, there could be another company giving out dividends only biannually. And similarly, there could be another company giving out dividends annually only. Only once a year they are going to declare dividend. And having said that, there could also be a company which normally doesn't follow a regular pattern when declaring dividends. So like there could be differences. The decision of giving out a dividend is purely based on the company. Like the company can decide whether they are going to declare dividend or not. But if they decide to declare dividend, that of course would be a benefit for the investors. And dividends are being declared on rupee terms, like let's say dividend declaration comes at 5 rupees a share. So based on the number of shares that you are holding, you would be entitled to that benefit, the dividend amount into the number of shares you are holding. So that's a dividend. A dividend is a portion of profits out of the company being divided among the shareholders of the company. And then we are going to look at rights issues. A rights issue is actually what's happening under rights issue. Let's say the company, after issuing their shares, after some time, some years down the line, the company needs to get additional funding. Maybe for some of their projects, they need. The easiest way for a company would be to collect more capital from their existing investors. So what they does is, like, in order to collect additional capital, what the company does is the company would make a rights issue. So in a rights issue, what happens is, as an investor, let's say the same company, the share is currently trading at, let's say, 12 rupees a share. And under a rights issue, the company would allow the existing investors to buy new shares of the same company at a discounted price. Let's say you would be able to buy that same share for 10 rupees. The share is currently trading at 12 rupees, and you would be able to, under the rights issue, you would be able to buy the same share for a price of 10 rupees. So thereby you would be able to enjoy a benefit from the rights issue as well. So this rights issue is a special one where that entitlement would come to the existing shareholders only. So if you are an existing shareholder of that particular company and they decide to make a rights issue, then only you would be able to have your rights and obtain that profit. And then we'll be looking at capitalization of reserves. So sometimes we call it as a bonus issue as well. So under a capitalization of reserves, what happens is, like, if you happen to see a balance sheet, or we call it the statement of financial position nowadays. So if you happen to look at a balance sheet of a company, you might see under capital there is a line called reserves. So reserves are the saved up money within a company. Maybe sometimes companies earn profits, they don't use it for any purpose, and they pile it up within the company itself, and those money is shown under reserves in the balance sheet of a company. So companies sometimes may decide to make use of that money and give out shares freely to their existing investors. So what the company is doing is they are making use of the reserves within the company, and they are giving out free shares to their existing shareholders, and thereby they add that money to the capital of the organization. Uh, when an investor is concerned, yes, you will be getting some shares freely from the company when a capitalization takes place. So that's why we call it a bonus issue as well. And of course, it's going to be a huge benefit for when the investors are concerned. In things like rupees, you might get it freely, and of course, that would be a benefit for an investor. And then we are looking at share splits. So we call it a subdivision as well. Well, talking about share splits, actually there is no direct cash benefit involved in a share split. But then again, in terms of liquidity, it's going to be a actually huge benefit for an existing investor. So let's say like you all know that the price of a share is decided based on demand and supply. So over time, when the demand for a share increases, what happens is the price of that share also increases. So let's take, for example, there is an investor coming to the market to make his initial investment for 10,000 rupees. So when he's trying to invest in the market with 10,000 rupees, there are like a number of ways for him to choose from, like which share to invest in. There could be like shares trading at, let's say, less than 10 rupees a share. And there are also shares trading at less than 100 rupees a share. And there are also shares trading at, let's say, like 2,000. Let's take into comparison a share trading at, let's say, 2,500 rupees a share. So if you take an investor, like a small investor, as per example, the attracts for a small investor. So let's say if he is to invest 10,000 rupees and if he is to buy those 2,500 rupees shares, he would only be able to buy shares of only 4 shares of that particular company, which is 2,500 rupees a share. So it's not that really attractive for that investor. But if, on the other hand, if you if you take a look at the shares which are, let's say, less than 10 rupees a share, that's going to be really attractive for that investor as well. So likewise, when such situations are created, the demand for high value shares may drop over the time. So what it does is they go for a share split. So once they do a share split, what happens is, like, let's take as per example, we have a share trading at 2,500 rupees a share, and the company decides to. So now, before the subdivision, you had a share of 2,500 rupees, and then after the subdivision, you now have 10 shares, but worth 250 rupees a share. Clear? There is no, actually, there's not going to be any change in value of your investment, but then again, in terms of liquidity. Now, after the subdivision, as the shares are trading at a value of, let's say, 250 rupees, it would be more accessible and attractive for most of the investors as well. So what happens in a subdivision is, like, your share would be divided into equal parts, like we call it, you split your share, and then thereby the liquidity for that share increases with the decrease of the value of that share, as the share is now more attractive to more and more investors. And then we'll move into indirect benefits. Like the first one we are gonna look at is like the fact that to trade in the stock market can be used as a collateral. So like there are many instances where you have to provide a collateral, maybe for a bank. This actually comes in very handy when you are gonna travel to overseas. Like in most of the cases, when you are gonna obtain visa, you would have to declare your assets. So when declaring your assets, the fact that you are trading in the stock market, or that you are having investments in the stock market, you can keep it as a collateral, or you can show it as an asset when obtaining visa as well. And then talk about liquidity. Actually, when compared to the other like alternative investment opportunities available in the market, the investment in the stock market is considered a very high liquid investment in comparison to the other investments available. When you say it's liquid, what we mean is like it is very easy for you to convert your investment into cash at any given point of time. Maybe even within a few minutes of your time, you can sell your shares and convert it into cash without any hassle at all. And then the stock market investment has been able to provide returns above and beyond inflation over the past few years of time as well. So when you are making an investment, let it be the investment, it is important that you take into account the inflation rate of the country as well. So let's take, if you have to take a savings account once again into example, for your savings account, maybe let's say you get a return of 4 to 5%, an interest of 4 to 5% per annum. Annually, you get a return of 4 to 5%. But then again, if the inflation rate is above that rate, let's say like if the inflation is at 7 to 8%, well, actually you are not really gaining anything out of increases. At the same time, on the other hand, when the inflation rate goes up, your real value of money is actually decreasing. And then, so when looking at the stock market over the past few years, if you look at returns above and beyond the inflation rates that has been in place within the country. So if you buy shares, you happen to be a owner of a company as well, in a sense, like depending on the number of shares, the percentage of shares which you are holding, you get a partial ownership of the company. And then at the same time, based on the number of shares you are holding, you also have the opportunity, the chance to be appointed as a director of a company as well when you are investing in the stock market. So those are like the main benefits one could obtain or enjoy by investing in the stock market. I believe that was clear. Like if you all do have any concerns while I am explaining this, please feel free to type in your questions. As and when you have any clarifications, when you need any clarifications, please feel free to type in the space where you can type in your questions. So I'll be able to take a look at them as we move along, or if not, take a look at them as well. So having looked at the benefits, now let's move to look at the more practical aspect of it. In a sense, like in order for one to enjoy the profits, the benefits which we discussed, it is important we should purchase shares or buy shares. When it comes to purchasing shares, actually there are like you have two options. In a sense, one could buy shares of the primary market and of the secondary market as well. So in a primary market is where in a primary market, what happens is companies come to the stock market for the first time. So the company is getting listed in the stock exchange for the first time, and they are issuing shares to the public. So when you buy shares of the primary market, you become the first set of shareholders of that company. And when you put your money to that company, what happens is your money goes to that particular company through the stock exchange, and then in return you are going to get shares of that company. So that's the primary market. And then talking about the secondary market, what happens in the secondary market is like the shares which you have bought from the primary market can be traded in the secondary market. Like let's say you buy shares from the primary market, and after some time you want to cash out your investment, and now you have the opportunity of selling your shares in the secondary market. So let's take a look at the primary and the secondary market in more detail. So as I explained, primary market transaction happens between the investor and the issuer, the company. So what happens is, let's say there are investors with surplus money, and they decide to put their money in a company which is going to come into the stock market for the first time. And then when you put up your money in that company through the stock market, the company in return issues shares to the investors. And then in the secondary market, the transaction happens between an investor and another investor. Both shares from the primary market can sell their shares in the secondary market. And in the secondary market, you are essentially selling your shares to another investor just like you. For any investor to buy shares, in order to buy shares, one should open up a CDS account, we call it. You should open up an account with the Colombo Stock Exchange. We call it the CDS account. CDS stands for Central Depository System. Actually, Central Depository System is where all the transactions or the records regarding your trading or the transactions related to your shares are being recorded. So like your withdrawals, transfers, and is being done and recorded in the Central Depository System only. So that's why we call your account the CDS account. And for you to open up a CDS account, you would have to go through a stock brokering firm. So it is a must that you select one of the stock brokering firms in order for you to join with the stock market. So about the stock brokering firms, these stock brokering firms act as intermediaries for individuals, for investors to start investing in the stock market. So as of now, there are like around 20 stock brokering firms in operation, which are ready to help you out, help investors to come into the stock market. So if you talk more about these stock brokering firms, like these stock brokering firms, they do have a separate research unit. Like each and every stock brokering firm, they maintain a research unit of their own. So what these research units does is they take some from time to time, they take some companies and they do an analysis on these companies to consideration. Like they take out one company and they take into consideration their annual reports, like their performance into consideration, and then also they take into consideration, let's say, like political factors and other several factors which are affecting the performance of this particular company. And then they do an analysis, and at the end of their report, they give out a conclusion, like whether they give out a recommendation, as in what an investor should do with this particular company's shares, like whether to buy the shares, whether it is good to buy that share, or whether it is the right time to sell the share, or whether it is advisable to hold on to the share and you can sell it at a later point of time. So likewise, these research units, they conduct analysis on selected companies, and they do come up with a research report. So as an investor, when you open up an account with a brokering firm, through a brokering firm, you would also get access to these research reports as well. So there are like another number of services offered by brokering firms when you start investing in the stock market. So for an investor to buy shares, you must open up a CDS account, and when opening up a CDS account, it is important, it is a must that you select one of the stock brokering firms that are currently in operation as an intermediary. They would facilitate, or they would take you into the stock market, and they would guide you through when you are to do your transactions in the stock market. So once you have opened the account and when you are going to buy shares, there are like different instruments, we call it, when you are to do your purchasing. Like I've taken few types, few main when you have to start trading, you will find out. So let's take a look at ordinary shares first. If you take ordinary shares, actually there are like two types of ordinary shares. One is ordinary shares with voting rights. That's the most common that we see in the market. And the other is ordinary shares without voting rights. We call it non-voting ordinary shares. This voting comes into place like, these companies, they do have their AGMs, annual general meetings. So in these annual general meetings, what happens is they take all the decisions, the plans regarding the company's future are being presented in these AGMs, annual general meetings. So if you happen to, when you happen to be a shareholder of a company, you are invited to these annual general meetings. So when you attend these annual general meetings and when they present their plans and they take a vote on the plans, whether to go ahead with that plan or not. That's decided based on the votes of the shareholders of that company. So when you are a shareholder, when you are an ordinary shareholder with voting rights, you can cast your vote, like whether you are willing, you can cast your vote for or against those plans, decisions that are being presented. So that's the only difference. Like if you happen to be a shareholder without voting rights, you could still attend the AGM, but you would not have the chance of casting your vote for the plans or the decisions that the company is gonna take. So that's the main difference between voting and non-voting shares. And then if you take all these shares, they do have a, we call it the symbol, the ticker symbol, like they have a coding. For example, if you take commercial bank, the code for commercial bank would be COMB.N followed by normally 4 zeros. So if you see like COMB.N would represent an ordinary share with voting rights. And if you happen to see COMB.X, so by now you know that it's a ordinary share without voting rights. So if you take a look at the market, like when you in the future, when you start investing and looking into the market, you might see there are some shares like COMB.N, COMB.X, like most of the banks, they have issued non-voting shares, and then you would find out like few companies have issued non-voting shares as well. So it is important that you have that understanding if you are to start investing in the stock market. So that's about ordinary shares. And then talking about preference shares, denoted by a P, letter P. And then preference shares, if you take, when you buy preference shares, actually you don't really get the ownership of the company, but instead you are entitled for a fixed dividend. Like most of the times, preference shares do get a fixed dividend. Like upfront, when you are buying the preference share itself, you know what your return is gonna be. Like whether it's gonna be 10%, 12% per annum, you know what your rate of dividend is going to be. But on the other hand, you don't get the ownership of the company when you happen to buy preference shares. And then there is a document called warrants, a category called warrants. A warrant is actually a document which gives the holder the right to buy shares of a company on a future date, but of course on a price which we agree upon today. Like if I'm to take an example, let's take John Keels. If you take John Keels, and we'll say John Keels currently is trading at a price of let's say 140 rupees a share, and John Keels issues a warrant giving stating the terms as let's say after 1 year's time, the warrant holder will be able to buy the same John Keel share at a price of let's say 150 rupees, irrespective of the price that's gonna be in the market after 1 year's time. So let's say John Keels is currently trading at 140 rupees, and if you buy a warrant today, you would be able to lock in that price of 150 after 1 year's time, irrespective of the price that's going to be there in the market after 1 year's time. So let's imagine there could be an investor who's thinking like John Keels is already doing really good, they are performing really well. So after 1 year's time, they might perform really well within that year as well, and the share price may go beyond 150, so it may reach even like 160, or could reach up to 170 as well. So if I am in a position to lock the price of 150 today itself, I would be at a very advantageous position after 1 year's time. So an investor who thinks on that angle would definitely buy these warrants where he would be able to lock in the price of 150 after 1 year's time. So the demand for a warrant is based on the angle an investor is going to look at the future of that particular company. But a warrant is actually, in theory, is a document which gives the holder the right to buy shares of that particular company on a future date, but at a price which we agree upon today. It is important that you know what a warrant is. Like time to time, there could be warrants coming in the market, but as of now, I don't think there are any warrants currently trading. But as they come along, when you have this understanding, you know what a warrant is and what you can do, what the benefit you can get out of a warrant. And then looking at debentures, actually, when you buy a debenture, it's like you as an investor giving a loan to the company. So debenture has a maturity date. So when you buy a debenture, you know the date where you are gonna get your capital back. Let's say they are like debentures like for 1 year debentures, 2 year debentures. Likewise, you know what your investment period is going to be, and at the same time, you know your return as well. It's going to be a fixed return. Like upfront, when you're buying the debenture itself, you know what your return is going to be, whether it's going to be 10%, 8%. Likewise, you know what your rate of return is going to be. When the company is concerned, it's like you giving out a loan to that particular company when you buy a debenture. So that's about the types of securities we could buy in when we start investing. So all these securities are being traded in a system which we call the automated trading system. We normally call it the ATS. So through this system only, all the transactions are being taken place when you are to do your transactions or the trading activities in the stock market. So one line in this system would show a transaction. You would be able to see the price and the quantity. Let's say like here you might see 1,200 shares being traded at the price of 1.80 a share. So when you are to buy shares of this system, what happens is like if you are to buy shares, you contact your broker firm and you place an order to the system. So once you put up an order to the system, this is how it's being shown. We call this the order book. So once you have opened your CDS account, you would get access to these facilities. So before entering an order to the system, normally what we do is like we take a look at this order book. So when you take a look at the order book, here you see bids and asks. Bids are the purchase side, buyers, and then asks are the sellers. So if you take a look at this share, which is Expo Lanka. So as per this order book, currently there are sellers, the best seller is at 171.75, which means currently an investor is willing to sell his shares for a price of 171.75. And on the other hand, the best buyer is at 169 rupees. So he is willing to buy Expo Lanka shares at a price of 169 rupees if available. So now when you are, let's say now you are also trying to buy shares of Expo Lanka now. So now you can decide based on your income. Let's say you want to buy Expo Lanka shares immediately. And in that case, let's say you put up an order for 171.75, and then immediately the system matches your order, because now the system has a buy order for 171.75, and at the same time the system has a seller for the same price. So now when the system has a buyer and a seller for the same price, the system automatically matches it to execute a transaction. So I believe it's clear. Before entering order, you take a look at this order book, and then you place your order to the system, and the system automatically matches your orders, the buy orders and the sell orders. And the matching process would take place based on price, like the best price would get the priority. And then let's say there are like two orders, there are like two investors have put up orders for the same price. So then in that instance, the time comes into play, like the person who entered the order first would get the priority in such a scenario where the price is same. So you would get to know this when you start investing. Like initially, your stockbroker, the advisor, would do this part for you. But then, as you move along, when you get into like online trading facilities, when you start using those facilities, you would be able to get access to these order books and all other information. So talking about the trading sessions, like for you to do transactions in the stock market, there is like a time frame that is normally from 11 to 2:30 on daily. That would be the time where you are allowed to buy and sell your shares in the stock market. There is also like a 10:30 to 11 a grace period, like where you can enter your orders to the system. You can keep your orders entered to the system, but the matching process would start at 11 a.m. only, and from 11 to 2:30, it would be the regular trading where you can put up your orders, and the matching would also takes place. So from 11 to 2:30 is the regular trading time, and at 2:30 the market closes, and thereafter you won't be able to trade in the market. And the market operates on weekdays, Monday to Friday, except for the bank holidays. So all 5 days you'll be able to, from 11 to 2:30, you will be able to do your transactions. So unlike any other place when you are doing transaction in the stock market, there is a small fee, the cost involved. The transaction cost when you are trading in the stock market would be 1.12%. That would be divided among few parties. You all know a portion would go to the stockbroker firm, and then a portion would come to the CSE, the stock exchange. A portion would go to CDS as well for the Securities and Exchange Commission, and then to the government as a transaction levy. A small portion is being given. But as far as an investor is concerned, the total cost for a transaction would be 1.12%. So like if you are buying shares with, let's say, 100 rupees, you would have to bear an additional cost of 1 rupee and 12 cents. And that would be the only cost involved when you are transacting or investing in the stock market. So with that understanding, let's take a quick look at the CSE performance indices. Like actually these indices are there for an investor to get a general understanding about the behavior or the movement of the stock market. So if you take a look at out of these 4 indices, actually the all share price index and the S&P 20 index are the most important indices that you should look at. If you take a look at the all share price index, actually as the name says, in the all share price index, you will be able to get an understanding of the movement of all the shares that are currently trading in the stock market. So all share price index gives you an overall picture about the movement of the stock market as a whole. So let's say all share price index, when you look at it, let's say the value is today, the value is at 7,500. The index value is at 7,500. And yet, if you compare it with yesterday value, let's say it was 7,400. Yesterday it was 7,400. Today it's 7,500. So which means the market has moved up. So all these indices, we interpret them on a comparative basis, like we compare it with the previous day only. So as per example, if the all share price index is 7,400, it was 7,400 yesterday, and today if it's 7,500, which means the market has moved up. So in the newspapers and in the TV news also, you would hear as the market has moved up. So similarly, if the value was 7,500 yesterday and today it is 7,300, means that the market has moved down. But that doesn't mean that all the company shares has gone down in value. So on a particular day where the market has moved down or gone down, there could still be investors who had made a considerable gain during that day itself. Like say like when you are buying shares, you don't buy all the company shares. Like you select few companies and you buy shares. So your profit or loss that you have gained or lost would depend on the movement of those companies which you have grown. Like the all share price index gives you a general understanding, gives a general picture only. But on a given day, like where the market has gone down, there could still be investors who have gained few bucks during that day itself. So when you start investing, it is important that you have that understanding. There are sometimes when you hear that the market has gone down, some people panic and they try to sell their shares. But it should not be the case. The indices gives you a general picture only. Apart from that, for you to identify the real loss or the profit which you have made, you would have to look into your shareholding and then decide whether you should sell or not. So that's about the all share price index. And then the S&P SL 20 index, as you would see in the name also, on the S&P SL 20 index, we take into consideration only 20 selected companies. These companies are being selected based on size, liquidity, and financial viability. So this S&P SL 20 index represent the movement of those 20 companies only. So those are the main 2 indices which we come across when we start trading, and then we have the sector indices. Like we have divided all the companies. As of now, there are like 290 companies trading in the stock market. So all these companies are being divided into various sectors. Like there are around 20 sectors. So the companies are being divided into those sectors, and you'll be able to see the performance of each sector under the sector indices. And then we have the total return indices as well. But out of all these, we would mostly be looking at all share price index and the S&P SL 20 index. So with that, this is what we have spoken of as of now. We have looked at overview of the Colombo Stock Exchange. We talked of risk and return, the benefits, and then we looked at how one could purchase shares. Under that, we talked of several other topics, and then finally, we took a look at the all share price index and the S&P SL 20 index. So with that, I believe we can move on to the account opening process that would be conducted by my colleague Streamer. And in the meantime, if you do have any concerns, any questions, like any areas which you need clarification, please feel free to type in your questions and send them to us. We will be able to take them up before we wind up the session. All right, with that,